Very excited to have our inaugural guest speaker join us straight from the EU, Doris Honold, the former Global Chief Operating Officer of Standard Chartered Bank. Doris, really excited to have you on the show today. Tell us a little bit more about yourself.
Hi, hello. Yeah, I'm here live from London, and I'm Doris. I have 25 years of financial services experience in very say traditional banks, traditional organizations. I had a lot of different roles in Frankfurt, London, Tokyo, Singapore. Mostly in the risk function and chief operating function, and my last role was, as Alex mentioned, in Standard Chartered Bank, which is a British bank but operating across 60 countries, mostly in Africa and Asia.
Amazing. And you're also on the board of Zopa, one of the leading peer-to-peer lenders, which we'll talk more about later on or in a little bit. But, Doris, I think just at a high level, it'd be great if you could, given your vast knowledge of banking, could you just explain to us, how does the actual loan underwriting process work, and what goes into all of that?
Yeah, I'll give it a go. No, because of course it's always, if you ask the question, it's quite different if it's a loan underwriting for an individual or a large corporate. But they're of course the same elements, and I describe it in three levels. And the first one is always kind of the strategy. So the bank really agrees what is our strategy, who do we lend to, what do we do, what do we actually know, and where do we want to be in business? Like one good example is that a lot of banks changed their strategy, given all the climate change activism, to not lend to coal companies, for example. So there are reviews of the strategy which right at the beginning say that's a good idea to look at, or that's not a good idea. We just don't want to do that. The second level is then the risk appetite. It's quite critical that the banks decide upfront, that's the size of our balance sheet, how much do we want to allocate to loans? And then within this allocation, how much do we want to lend in specific countries and specific sectors? How much do we give to telecoms? How much do we give to real estate lending? And you already have quite a detailed framework. And then really comes the individual loan decision, the individual credit analysis, where you have a client coming with an idea and you really assess, and you in essence assess what's the probability of getting the money back. And if I look at what happened over the years, the biggest change and the biggest part of innovations has really happened in this credit analysis piece. These days, the algorithm used by banks are a lot more sophisticated. The number of data elements is a lot higher, because in essence, the better your predictive power, the more likely is it that you're going to outperform your competitors.
Great. And I think that gets to kind of this trend of automation and using data in the underwriting process. This is a survey from 2012, which was surveying banks and where they are in the process of automating, different parts of the underwriting process. So from compliance related to different concentration limits and different portals for data gathering. And the dark kind of blue on the left is using it. The medium is don't use it. And then all the way on the right is don't know. And then this is from Elevate, which is a FinTech lender, went public in 2017, I believe. And so it talks similarly kind of how they are using data, using automation to streamline the underwriting process, looking at credit scores, fraud scores, instant decision making on 95% of loans. This is an overarching, overgeneralized question. But if you look at the role of, say, banks' ability to automate and streamline and use data in the underwriting process versus the fintechs, how would you compare and contrast those two?
I'd say fintechs are probably ahead of it in certain areas, and I think a lot has happened in banks over the last 5 years, and that's really as a consequence of the challenge by fintechs. Because if you look at what the loan market is, there is no differentiation in product. It's not like buying a car or a house. In essence, you want money. So it's not different. The money is the same if you get it from this bank or from this fintech. What is the only two differentiation are the price, your loan rate, and the convenience. And this is really where I think fintechs have done an excellent job on both, like having more competitive pricing as a result of better models, and making it more convenient through easy interfaces. But of course, it's difficult. So fintechs have their pockets where I think they're definitely competitive and ahead of banks, and banks are reacting to that and investing heavily and catching up, and in certain areas maybe are on the same level or leading through either collaborations with fintechs, or in areas where fintechs are more tailored, and banks usually have a lot broader offering. So that's I'd say. But I think fintech, to their credit, have started a really good process where, in the end, the client is the winner.
Yeah, and that's a fantastic point. Being broad versus focusing on a few specific areas. And I think that's been a big challenge for a lot of the fintech lenders, is because very often you see them focusing on, say, a few industries or a few type of personal retail loans, whereas banks generally have just a much wider breadth of loan portfolio that they're comfortable providing. What are the main drivers as to why you see that shape up? Is it more just the banks have a larger balance sheet? They just have experience building the credit models across a wider array of industries? Is it that the fintechs just don't have the ability to have the models that scale across as large of a portfolio? Or why do you see that kind of more nichiness from a fintech lending focus?
I think banks are broader because historically they have been broader. I think it's really a big argument is the history. A big argument might also be that banks maybe have more of how to say that, social responsibility to cover the whole spectrum. And I think fintechs, of course, if you start something and you want to reach scale, then you have to be focused.
Yeah, I was reading an article that some of the big banks in the U.S., maybe it was Bank of America, that they actually don't make money on half of the retail loans they're issuing, and maybe it kind of gets to that. Maybe the fintechs are right to focus on some of the juicier areas, and the banks, whether for regulatory or societal or just that's the way they've done it, have a much broader portfolio, but maybe not as profitable of a portfolio. Yeah, that's interesting. So, what about, okay, so banks are lending this money. In the US, banks can borrow from the Fed, basically. They pay a 50 basis point premium. So if the Fed fund rate is like 1.75 to 2%, which is where it's at now, they pay an extra 50 bips, and then they basically just get to resell that debt. So they're kind of like just giant distributors of debt capital. You kind of think about it that way. And, I guess what, if you are a AAA, grade A kind of borrower, what are you getting debt at? Like 4 points today or somewhere around there, and so the spread isn't that large, but they're reselling this capital. I assume it basically works pretty similarly in the EU with the ECB, right?
Yeah, of course.
And then the next thing is, so then I think people understand that. Fintechs, however, don't have the luxury of borrowing from the Fed in that same capacity, right? And that's a regulatory reason, that they're not regulated like a bank, therefore they don't get access to, what is it, like the discount window or something like that? Is that all accurate?
That's the point. Whereas you see, at least in the UK, all these fintechs who started as a fintech very quickly got a banking license, and actually the UK regulator was fairly flexible in giving out the licenses, because they're still differentiating how do we regulate a big bank versus a tiny new fintech bank, and what can you do. But the whole motivation about showing that flexibility and making it easier to get a banking license was the idea that they like the idea of new competitors coming in. So it's the whole idea of competition is positive for the consumer.
And the impetus for a lot of those fintechs to get a banking license, right, is that it gives them access to basically a cheaper source of funds than if they don't have the license.
The other topic that you hear a lot about these days, but I don't think many people know, is quantitative easing. And so I'm going to take a stab at how I would describe this, and then you let me know how I do. So my understanding of it is that, so if you're a bank, the Fed and the central bank, so the ECB in Europe, would say you as a bank have to hold certain amount of cash reserves on your balance sheet, and they can, lower or increase that reserve amount based upon what the Fed wants to do in terms of maybe increasing or decreasing the amount of lending that banks are doing, right? So if they have to keep more cash on the balance sheet, that leaves less capital that they can lend. Now, quantitative easing is that they could keep the reserve requirement the same, but what the Fed can do is say, we're going to buy marketable securities, or we're basically going to buy loans from you, bank. And now you're going to have essentially more cash. You're going to have a more liquid balance sheet, which now opens up more capital for you to go and then lend that money out to other either retail or commercial borrowers. So far, so good on that?
So far, so good. Yeah, it's the whole point is just to generate liquidity for banks to lend out, to bring more money in circulation.
Now, the interesting thing is when the Fed does this, they just do it. They just make up the money. The money just appears. It's kind of like they're a genie and they snap their fingers and boom. Okay, I just bought $100 billion of your debt, Bank of America. Okay, there you go. There's $100 billion. But the interesting thing is that the money never actually transfers to Bank of America from the Fed. They're just kind of, it's really an accounting thing where now
ones and zeros in a computer.
Yes. Now the Fed says, oh, well, you have $100 billion. I'm just making up the number of more liquidity because I have, acquired these securities from you. So all of that's very interesting. So it's just another way, it's another mechanism to, as you're saying, either increase or decrease liquidity. The interesting thing about it is it's not as hard-coded of a metric, right? It's not saying, here is the reserve requirement, here is the Fed funds rate. It's kind of this more amorphous activity that you either know that the Fed is doing this or not doing this, but it's not as measured as saying, as the other metrics. So it's not as clear to everyone the degree of liquidity or lack thereof that's being created by the central bank. So that's really interesting. Let's go a little bit more into the fintech lending landscape. And let's start with Zopa. So Zopa it's a very interesting company, probably the leading peer-to-peer lender in the UK and in Europe. You've been on the board there. Well, how would you describe what Zopa is and what makes it so great?
I think what Zopa is most proud of is that they're, I think, the first peer-to-peer lending company in the world. So they really started 14 years ago. And so therefore, they're also a FinTech or peer-to-peer lending company who has been through a credit cycle and who are still around. So that's proof point that even fintechs can survive a credit cycle. I think if I would describe Zopa, I would describe it as what's the and Zopa, by the way, also just recently got a banking license. And their vision is really, if you look out there, then there are a lot of people who are stressed about money and who think managing money is just painful. And they basically want to create a space where managing your money is easy. It's actually fun. So that's why all they're doing is, what does it make? What is it that it makes easier for clients to manage their money? So that means not using any jargon. That means transparency on your pricing, no hidden fees, etc., etc. So, for example, if you go on the Zopa webpage, you want a loan, they give you they say you will get the loan and this is the rate, and they tell you that before you officially apply for the loan, and that just makes you feel in control, because it's very disturbing if you apply and then you get like a ridiculous rate, or you get declined, and it might impact your credit score, etc., etc.
It's geared towards the retail investor, right? Looks like, personal loans, car loans, other things like that. So very cool company. Now, I found this graphic. I was at a lunch with Anna Boten, the executive chairwoman of Santander Bank, on Monday. And she was saying, well, fintech lending is much higher in the United States than it is in Europe. This is from 2017. It shows about 36% of the personal loan industry. So this isn't everything, but a good indicator that fintech lending is certainly on the rise. Banks actually have only about 25% on this chart in the US. But what she was saying is that in Europe, the spread is much different. Banks actually still have a majority of lending, and the kind of the ratio is somewhat inverted. Well, assuming that's true, I guess, why is that the case? What would you say is different US, Europe, as to why you see banks having a smaller portion in the US versus Europe, or fintechs maybe having more penetration in the US than in Europe?
That's interesting. And I probably read the same article Anna read, which was in the FT, and I was surprised as well to see that fintechs with respect to lending haven't really grabbed a lot of market share in the UK. What are the reasons? I think there can be a whole range of reasons. One could be timing, that it's too early. For example, Monzo, a very successful UK challenger bank, has only recently started to offer loans. So their focus was first on making the whole payments, money management easier than giving out loans. So with Monzo, I guess it's definitely a timing issue. So we'll see. I mean, I read something interesting about the UK fintech lending space, which gives us a slightly different angle to it, and which is, I read that in the US, still a lot of people, the first stop is at traditional banks, and if they get declined by traditional banks, they go to challenger banks. So kind of indicating that challenger banks get a bigger share of the pie, but maybe also more risky or lower credit scores. So, I think it's probably worth having a more detailed analysis on this, but it's definitely a very interesting fact.
Well, and that's a great point. And actually, so this article is a little bit older from the FT. It's from 2015. And it talks about Metro Bank, which is a challenger bank in the UK, partnering up with Zopa and providing loans on Zopa. I'll come back to that in a second. But to your other point, it also says here that Santander and RBS did a partnership with Funding Circle. Different partnership where they're basically saying, hey, we can't lend to you. So here's this group called Funding Circle. And I'm sure Funding Circle is kind of paying like a referral fee or something like that for essentially those rejected borrowers in this model here. Now, what is more interesting, though, is that to me is kind of like a lending marketplace 1.0. That's kind of like what we've seen in the other direction with a lending tree or a bank rate in the US where, they're saying, hey, I'll connect you to a variety of different borrowers. It could be banks, it could be FinTech lenders, and then they collect a fee from the lenders to make that introduction. I'm sure that's kind of similar. What was very interesting in this article was the description of now, this is now a number of years ago, Zopa going beyond just what you would consider peer-to-peer. And peer-to-peer would imply individuals are lending to other individuals. But this was, I think, probably the first case. I think they have some other partners now that aren't necessarily all banks. I think there's some funds that are doing this, but where they're now getting institutional money to come and provide capital to the Zopa borrowers. And I think this model is really interesting. And I would imagine is working pretty well for them. Is there any other context that you can share on that?
No, I mean the way I look at it is that Zopa has built, might be a very successful peer-to-peer lending platform, and there are other players out there, Metro Bank or other funds who have excess liquidity. And peer-to-peer, an individual investor who likes the platform as an investment, that's an interesting way to deploy excess liquidity. So and for Zopa, they have a mix between funding from individuals and funding from institutions.
Mm-hmm. Now, what's interesting, though, is Lending Club, which, started as peer-to-peer. A lot of people have criticized Lending Club because now the peer-to-peer lending side of the business has actually declined a lot, and it's more so gobbled up by just a handful of large banks and institutions. I see that model with Lending Club as being different than Zopa. I see Zopa working with institutions, but not the kind of incumbent banking institutions that Lending Club is working with. Is that accurate, Nick? Would you say?
Lending Club works with a pretty broad swath, including a lot of the big institutions, Goldman, hedge funds, big banks.
And I think what's interesting here is the difference between a personal lender where Zopa says, hey, let's say Alex is applying for a loan. Here is the credit risk. I think they have ABC. They have different grades they're going to provide to my application. And then they are associating that with a certain level of interest rate that then they are now letting individuals lend to really a portfolio. So, if I'm a lender, I put in $10,000, they might split that $10,000 across, let's say, 10 loans. And me as the lender, I can pick what risk profile I want for that basket and so on and so forth. the larger institutional lenders here will obviously need to put much more capital to use, so they will provide the whole loan, say to me. But what is interesting, I think, and this isn't, say, Zopa specific, is when you have institutional lenders that can now start to put larger sums of money to work, that can use the data, that can have their own algorithms. Do we see a model where those institutional lenders, the platform could still say, here is what we think Alex's risk rating is. Here is all the data that Alex provided about the loan that he wants and his credit profile, so on and so forth. And is there a way where we can have these lenders compete over my loan? And let's say one lender is now, they are creating their own interest rate to suggest what they would lend to me at. Maybe one says, well, I'll give Alex 6%. And one says, I'll give Alex 5%. Is there a way that you can now centralize these transactions and kind of put a forcing function on the lender base to do that competition? Is that a direction you see the industry going? Is it already there?
No, I mean, of course, that can happen, and of course, you can look at it both sides. Now, I'm not sure if Alex is a good example. I guess it depends on the size of your needs, I guess. But the point I'm making, it always depends. If there is excess liquidity, which as a result of too much quantitative easing, yes, then they're going to all compete about Alex's loan. If there's not enough liquidity around, you will have to shop around and see who will give you the best rate. So it's, it can turn around, but you're absolutely right that with platforms, a scenario where lenders compete about giving, being able to give you the money is realistic and feasible, and it wasn't 10 years ago.
Very interesting. And now we went full circle here. So you're mentioning Zopa's been around for 14 years. It's gone through a credit cycle. And as you're saying, look, the central banks really are able to exert so much influence over just liquidity and the lending dynamic. I think they're back to quantitative easing in the US. I'm not I should know that. But there was tightening and whatever. But yeah, I think that is the biggest knock that I hear from the skeptics about the fintech lenders is that, well, everything we've seen here has happened in kind of a bull case scenario. They haven't seen a downturn.
Historical bull market, of course, they're doing well.
Right. And well, that's all going to get turned on its head if and when we have a downturn. Maybe some of that's true. Maybe there are some people that are a little overextended, taking on a little too much risk. But directionally, I wouldn't agree with that. I have a little bit of bias, but you're from the industry. What say you?
I never like blanket statements. So if there's a downturn, will there be some defaults? Yes. Will there be some defaults from startups and fintechs? Of course. But that's kind of if you look at the the money, venture capital funds, the other lenders have put into startups and into fintechs, it's amazing. So there was really suddenly this huge amount of money which people were very happy to give away to new ideas, to challenger banks, challenger whatever. And of course, if you are in such an environment where everybody is kind of in this rush to find an opportunity of a new company to invest in, there are situations where you get carried away, and maybe there were a few investment cases who weren't as solid as they looked in the heat of the moment. But I don't think that's a function of fintechs not being thoughtful or professional or having excellent people who know how to ride out a storm. Like always, there will be some winners and some losers.
Yes, very true. We'll just see if the winners can take all, right? But anyway, sorry about that. Doris, thank you so much for joining us today. We hope to have you back again soon. Have a great rest of your afternoon, evening in London. Thank you.
Thanks, Doris.